So, what if I told you that the single biggest thing holding Bitcoin back from the banking world isn't its price volatility, but just one kind of obscure number? Yeah, it's a number that's basically a giant regulatory wall. And today, we're going to dig into why it's there and what it actually means for the future of finance. And there it is, 1,250%. Now, this isn't just a random number. It's the official risk weight that global banking regulators have slapped on Bitcoin. And it's so ridiculously high that it basically makes it impossible for any major bank to hold Bitcoin on its balance sheet. So, what on earth is the story behind this crazy figure? And this is where it gets really interesting, right? We all know that stocks can be pretty risky, but these rules, they're saying Bitcoin is 5 times riskier. Does that even make sense? Or is this just a classic case of regulators trying to fit a square peg into a round hole, looking at a totally new kind of asset through a really, really old lens? Okay, so let's actually break down what this 1,250% problem really means in practice. Because this isn't just some number in a rule book. It has real and, frankly, very expensive consequences for any bank that even thinks about getting into Bitcoin. So this all comes from something called Basel III. You might remember, after the huge financial crisis in 2008, all the major economies got together and said, hey, we need to make the banking system safer. And part of that plan was to give every single asset a bank holds a risk weight, basically a score for how dangerous it is. And this, right here, is where things get wild. Just look at this table. Gold is considered so safe it gets a 0% risk weight. Government bonds, also practically zero. Even mortgages, the very thing that blew up the global economy in 2008, they only go up to about 100%. But Bitcoin, it's just in a completely different universe, way, way out there at 1,250%. It's a massive outlier. It doesn't even look like it belongs on the same chart. So what does this do to a bank's bottom line? Well, think of it this way. For every single dollar of Bitcoin a bank wants to hold, this rule forces them to keep a full dollar of their own cash locked up, doing nothing. That makes holding Bitcoin insanely expensive from a capital perspective. In fact, just a tiny 5% allocation to Bitcoin on their books could force a bank to triple the amount of capital it has to hold in reserve. It's a total non-starter. All of this kind of makes you scratch your head and ask, is this extreme risk rating even justified? Let's take a closer look at what makes Bitcoin so fundamentally different from all the traditional assets it's being judged against. And this is really where you see the disconnect. With Bitcoin, you have a fixed supply. It's capped at 21 million, forever. We know exactly what the monetary policy is. Compare that to something like the US dollar, where the supply can and does change all the time. Bitcoin has no central issuer, no company, no government debt backing it. It's just a totally different animal than what these old regulations were designed for. One of the biggest mistakes that regulators tend to make is just lumping all crypto into one big bucket. But Bitcoin is completely unique. It has no CEO, no headquarters, no central party that can change the rules. And that makes it fundamentally different from pretty much every other digital asset out there, which all come with their own set of risks that just don't apply to Bitcoin. Okay, but here's the fascinating twist in all of this. What if the very thing that makes regulators so nervous about Bitcoin, the fact that it's digital and totally open, is actually its biggest strength when it comes to understanding and managing risk? We're talking about a level of transparency that's just radical. Because Bitcoin's ledger is public, every single transaction is right there in the open for anyone in the world to see. You just can't get that kind of visibility with a traditional bank's private books. It's like having a global army of thousands of analysts and even AIs watching the network 24/7. The entire system can be audited, in full, at any time, by anyone. Just think for a second about how risk is managed in traditional finance. You get a quarterly report, right? The information is already 90 days old by the time you see it. With Bitcoin, you have a real-time price, real-time data, 24/7, 365. You can check the exact risk profile of the network at 3 in the morning on a Sunday if you want to. For capital markets, that is a complete game changer. So you can see the problem here. The old way of measuring risk is just inherently flawed. It's based on information that's incomplete, it's often out of date, and not everyone has access to it. We're talking about huge financial decisions being made based on a fuzzy, incomplete picture of reality. And Bitcoin just flips that whole model on its head. All of a sudden, everyone has access to the exact same information at the exact same time. The risk is right there, out in the open, for anyone to see and measure. So the very thing regulators seem to see as a problem, this radical transparency, is actually the solution. So, okay, where do we go from here? Well, if we can see the risk with this much clarity, it means we can start to manage it in a much, much smarter way. We can finally move past these blunt, old-school rules and into a more sophisticated, data-driven world. So how does that actually work? Well, you can take all that public data from Bitcoin's entire history. Then you can run hundreds of thousands of simulations, stress testing it for every possible future market scenario you can think of. From there, you can generate these incredibly detailed probability curves that map out a whole range of potential outcomes. It lets you quantify and price risk with statistical precision.
And this is what you get. With traditional credit, your analysis is full of uncertainty. It's really just an educated guess. But with Bitcoin, you can build these probabilistic models using complete, real-time data. And that means you can manage risk with a much, much higher degree of confidence.
And let's be absolutely crystal clear about this. This is something you just plain cannot do with traditional assets. You don't have the data. You can't just peek inside a company's private books and run these kinds of powerful, forward-looking models. This level of precise risk analysis is only possible because of the transparency of digital assets like Bitcoin. Really, it all boils down to this one simple fact. We have better, clearer visibility into the risks of Bitcoin than we do for just about anything in the traditional financial market. The data's there, the tools to analyze it are there. It's really time for the regulations to catch up to the reality of the technology. So, at the end of the day, we're left with a pretty simple question. That 1,250% risk weight, it's a blunt instrument from another era, designed for a world of financial opacity. But Bitcoin lives in a world of total transparency. So if we can now see and measure its risk with such incredible precision, why are we still using tools from the Stone Age? What are we really waiting for?